Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 22nd of November 2023 and here are the questions we will be answering today. Will RBI retail lending caution give a fillip to loan apps? Ctrl+Altman, do Indian founders need a reboot? How long before the FPIs return to India? And what is direct-to-mobile broadcasting? Just about a month ago, RBI Governor Shaktikanta Das had flagged the high growth in unsecured consumer loans. He had also called for better surveillance. And now the central bank has hiked risk weights on these retail loans, credit cards, and on lending to NBFCs by 25 percentage points. It will translate into higher interest rates for all borrowers, but will it also give a fillip to loan apps? Ayush Mishra finds out.
RBI Governor Shaktikanta Das had flagged the high growth in certain components of consumer loans in October. Das had told lenders to strengthen their internal surveillance mechanisms. He wanted guardrails in place. And last week, the central bank made its move to enhance guardrails and strengthen internal resilience. On 16th of November, the Reserve Bank of India increased the risk weights for consumer credit exposure, including personal loans, by 25 percentage points to 125%. The hike in risk weight implies that banks and NBFCs will need to set aside a higher amount of capital for these loans, leading to an increase in the cost of capital. The adjustment applies to both existing and new loans. However, it excludes housing loans, education loans, vehicle loans, loans secured by gold and gold jewelry, and microfinance loans. Typically, commercial banks and non-banking financial companies, or NBFCs, face a risk weight of 100% for loan exposures. A hike in risk weights may lead to higher interest rates and reduced access to credit for consumers as banks adjust lending practices to meet increased capital requirements. This could impact borrowing costs and limit the availability of loans. It may lead to a rise in unsecured lending, creating room for the emergence of shady loan apps. People are availing far more unsecured loans than they were before the pandemic. The total value of these select unsecured loans rose 93% to Rs 14.3 trillion in August from Rs 7.4 trillion in the same month in 2019. According to credit information company Experian India, digital lending will surpass traditional lending on unsecured loans by 2030. However, the rapid growth in digital lending has also led to the proliferation of shady loan apps over the years. The increase in risk weight may further accelerate the growth of these apps.
Let us say that loan apps now. So now what may happen is the banks and NBFCs will have to put more capital because the risk weightage has been increased. So they will sort of reduce their direct participation in such loans. They'll reduce it, particularly the unsecured loans. In which case, loan apps will try and push that credit, and it will push the credit at a higher price. That's one problem. The second problem is if there is any aspect of non-recovery, then they will be very harsh and coercive. So those are the issues associated with loan apps.
Extending your logic, probably we'll see the money lenders also, coming in hordes to fill in the space, provided the demand for personal loans, what we have been seeing, or the rise in demand for personal loan is genuine, because people are, we understand that rural India is not in the best of health. People have lost their jobs, their income has also gone down. So they are resorting to taking personal loans. It's not a luxury loan for them. It's basically to continue with their life. If that is the case, yes, we can see the loan apps coming and exploiting the situation.
In his press conference post the MPC meeting in February 2022, the RBI governor had suggested that digital lending apps are not regulated by the RBI. And in September that year, the RBI came out with guidelines on digital lending. They were based on the recommendations of the Working Group on Digital Lending. But it seems That was not enough. Exploiting loopholes, scores of unscrupulous entities are still thriving, and reports of harassment and even suicides continue to pour in from parts of the country. So, what is the way out?
Money is a state subject. That's point number one. And now the central government has showed its concern. RBI has come out with the digital lending norms and redefining it again and again. So I think the best way is, of course, financial education. It's at some point we are talking about inclusive finance and reaching out to people. So the best way, of course, as I said, it's a legal issue. I think it's an issue with the police and the state governments, respective governments need to deal with. But most importantly, we need to have financial education using everything, social media and television channels, each and everything, and making people aware that don't get into that trap.
The responsibility clearly goes to the regulator. So therefore regulator will have to really do something. I mean, he cannot stop only at increasing the risk weightages for the banking and for the NBFCs. I'm sure he will take up measures, to save people from going to loan apps, basically.
Business Standard's Tamal Bandyopadhyay also said that RBI had in August recommended formation of a body called DIGITA, or a Digital India Trust Agency, to ensure that only authorized digital lending apps are used by consumers. So once the government accepts RBI's recommendations and establishes Digita, then we will have a certification agency to approve such apps. And then there will be an ecosystem of authorized digital lending apps. But till then, financial literacy and awareness will save people from falling into the trap of shady apps and moneylenders who are likely to fill the void created due to the RBI's move.
Most of these apps take the help of artificial intelligence and use algorithms to gauge the creditworthiness of first-time borrowers. And in the process, they are accused of excluding women and people from marginalized sections. Speaking of AI, last weekend saw a drastic change at OpenAI, the AI startup that developed ChatGPT. Its co-founder Sam Altman was fired. The reason? He wasn't consistently candid in his interaction with the board members. But can you imagine something similar in India? Unlike in developed countries where leadership changes are embraced, Indian founders are frequently seen as irreplaceable. Abhijit Kumar finds out why is it so, and is there a need for the founder ecosystem's reboot?
Unlike in the West, the long shadow of founders often looms large over their company in India, and they are considered irreplaceable. There's a cultural inclination to associate the success of a company closely with its founder. Experts believe that while this can foster a sense of loyalty, it also raises concerns about the sustainability of businesses if the founder's vision becomes too singular. One of the key issues arising from this founder-centric approach is the potential compromise in corporate governance. The founders, through themselves or through their family members, own a majority stake in companies, which makes it difficult for the board members to question the incapacities of the CEOs. And with founders wielding considerable power, questions emerge about checks and balances. So, is there a difference between how we treat our founders as opposed to the more matured economies?
We kind of tend to be a lot more softer on the founders as well as the CEOs of companies. Now, in the listed space, this is pretty obvious why. If you look at the listed companies, most of them, I'm not saying all, but most of them, you have the owner-manager. So you will have someone who owns 40, 45, 50% of the company, either directly or through the family. And therefore, it's very difficult for the board members to say that, look, we are really unhappy with your performance and we want you to leave, because the controlling shareholder, in this case the family, will have the ability to vote themselves in. Coming to founders and startups, what we haven't seen is we see less action, probably because a lot of the money which has come through has come on the back of promoters. So what are you doing? You're kind of not saying that I'm going to back a company. What you're saying is, look, I'm going to back an individual who has an idea and who we believe has the capability of rolling out on a business plan.
Founder of Sahara India, Subrata Roy, who passed away last week, ran the company to the ground. But none could question his decisions or put checks in place to avoid the disaster. Experts also gave the example of Byju's, where the founder is constantly under trouble and a slew of board members have quit. On the other hand, be it Sam Altman, the co-founder of OpenAI, or Steve Jobs, founder of Apple, were thrown out when the board decided fit. Experts believe that effective corporate governance requires a balance of power. When founders become synonymous with the company, it can hinder the establishment of robust governance mechanisms, leaving room for potential conflicts of interest. The gap between how Indian founders are treated compared to their counterparts in developed countries raises questions about sustainability and long-term growth. So, how can this gap be bridged?
I think this is a question of maturity of the Indian market. So over a period of time, slowly investors, that is the VCP investors, the media also to some extent now has realized that not all is hunky-dory. For companies, startup companies, unicorns go through, I would say, rough patches, and many companies would also fail. So to that extent, it is not that they need to be glorified. One. Two is the VCP community should also ensure that the companies are more mature. As the company's size increases, they need to bring in outside resources, probably external CFO, and the behavior of these companies need to replicate that of listed companies, for example. Can there be more disclosures? Can there be more, I would say, more openness towards transparency, etc.? There is no need for regulatory intervention. Okay, already Indian company law, etc., exists, and that is good enough.
However, some experts are of the opinion that the comparison between the West and India Inc. ecosystem is not justified.
The assumption was that what's happening in the US is necessarily good and what is happening in India is necessarily bad. I don't agree with that hypothesis. I believe that there are certain merits in the way our system works. One of the strengths of our microsystem or our markets is the fact that you've got families which own large chunks of equity. It may not always work, but there are enough instances where we find that the fact that you've got a significant owner of the business means that they can take a generational view about the business.
And with the Bharat Pay saga involving its founder, Ashneer Grover, it is safe to say that at least with the new age companies, things are shifting a bit, albeit very slowly. Experts say that it's crucial for Indian companies to cultivate a culture of institutional strength. This involves fostering leadership teams beyond the founder and implementing transparent governance structures that withstand transitions. As India aims for global economic leadership, the corporate landscape must evolve.
Let us now turn our focus to financial markets. After pulling out of Indian equities for 2 straight months, foreign portfolio investors have pumped in 1,000 crore rupees into Indian equities so far in November. Does this mean FPIs are finally returning to India, or is this just an aberration in sustained selling? Nikita Vashisht explores these questions in our next report.
Foreign portfolio investors, or FPIs, are beginning to slow their Indian equities selling spree. After dumping equities worth nearly 14,800 crore rupees in September and 24,550 crore in October, the pack has bought shares worth little over 1,000 crore rupees thus far in November. This comes amid easing US Treasury yields and the US dollar, which were the primary force behind the outbound flight of foreign flows.
the current selling that we are seeing on part of FPIs in Indian markets has got more to do with the fact that US bond yields crossed 5%. This resulted in a realignment of asset allocation and selling across EMs, which are perceived as risk assets. Within EMs, in fact, India has fared better.
Uncertainty over the US Fed's policy outlook, puzzling growth inflation dynamics, heightened geopolitical tensions, and mixed growth trends across economies kept yields, dollar, and oil prices volatile this year. From a low of 3.2% seen in May 2023, yields soared to 5% in October, which impacted the direction of flows across EMs. The US dollar index, meanwhile, touched a high of 107.7 and Brent crude hit $92 per barrel mark. According to Bank of Baroda research, China saw foreign capital outflow worth $41.4 billion between October 1 and November 15, the highest among EM peers. This was followed by outflows in Taiwan and South Korea. The US, on the other hand, saw inflows worth $29.4 billion during the period. However, as the US Treasury yields retreat to 4.3% on hopes of sooner than expected reversal in the US Fed's monetary tightening stance, could FPIs be returning to India?
Most FPIs, anecdotally, when we talk to, are looking for either a correction in Indian markets to take place or the dust to settle down on global macros before money will flow back.
That said, Nirav Karkera of Wisdom Research flags certain risks which may return the FPIs to the Indian shores.
Any strengthening on the dollar index or any worsening of the inflation situation or any potential interest rate hike continuing going forward could threaten some velocity of FPI inflows into Indian capital markets. Any risks around the subject of the general elections could lead to many FPIs waiting and watching as the situation and scenario evolves.
India, the fastest growing economy in the world, is undoubtedly on foreign investors' radar. However, developments around global inflation scenario and election results back home may keep a lid on FPI inflows in the near future. Today, on 22nd of November, markets will react to the minutes of the US Federal Reserve's latest monetary policy meeting.
He's making plans for an early retirement. Business Standard.
Do you miss your daily dose of market news due to traveling at times or at places where the network is weak? Well, the proposed direct-to-mobile broadcasting may offer a good alternative. But how? Harsh Shivam has more on this new technology.
Direct-to-mobile, or D2M in short, is a broadcasting technology capable of beaming multimedia content to consumers' smartphones without an internet connection. Traditionally, it has been used for sending emergency alerts and assisting in disaster management. However, its versatility extends beyond these conventional applications. With D2M, governments can broadcast citizen-centric information. Telecom operators can also partner with content providers to deliver multimedia content, such as live news, without straining network bandwidth. This approach benefits consumers by reducing their reliance on internet data consumption for staying informed and entertained. D2M technology functions in a manner akin to listening to FM radio on a smartphone, where a receiver taps into radio frequencies. Another comparison is direct-to-home or DTH broadcasting, in which a dish antenna receives broadcast signals directly from satellites and transmits them to a receiver, known as a set-top box. But currently available mobile devices do not support this technology because it requires the ATSC 3.0 standard. ATSC 3.0 represents the latest version of the Advanced Television Systems Committee standards, designed to define how television signals from different networks, including terrestrial, satellite, and cable networks, are broadcasted and interpreted by devices. To make devices compatible, With supporting next-generation broadcast networks under these standards, a separate baseband processing unit is needed, along with an antenna, low-noise amplifiers, baseband filters, and a receiver. Additionally, the current network infrastructure lacks the capability to transmit signals from D2M. This technology needs a dense network of terrestrial towers to receive signals from satellites and transmit them to streaming devices, reducing the size of the device's antenna. This is unlike DTH, which employs fixed rooftop antennas linked to broadcast satellites. Incorporating a separate baseband processing unit would significantly increase smartphone costs and potentially disrupt LTE and 5G networks' internal design.
I will achieve. I will fly high. I am the I in SBI. I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
This technology can also help students in remote areas by providing access to quality educational content. Farmers too can benefit. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.